They were sitting in the same brokerage account dashboard, same platform, same day, same headlines running across the bottom of every financial news channel in the country. Two investors. Both had been in the market for a few years. Both considered themselves informed. Both had watched the same news that morning. Another escalation in Eastern Europe, another round of sanctions, another emergency session at NATO headquarters, another spike in oil prices on the futures market. One of them did what most people do. She felt the anxiety of the headline, checked her portfolio, saw the red, and waited. Uncomfortable, but passive, hoping it would settle, telling herself she was a long-term investor and that short-term noise didn't matter. She closed the app and went to make coffee. The other investor did something different. She had spent time, not a great deal of time, but focused, deliberate time, understanding a specific set of connections. She knew which sectors moved when that particular kind of headline appeared. She knew the historical pattern. She knew which companies stood to benefit directly from the dynamics that headline represented, and which were exposed to the downside. She had already identified her positions in advance, with clear logic behind each one. By the end of that week, the first woman's portfolio had drifted down with the general anxiety of the market. Nothing catastrophic, just the quiet, directionless loss that comes from having no framework when the world gets complicated. The second woman did something different. She had closed 2 positions at a gain and opened a third that she would hold for the following month. Same headlines, same market, same day. 2 completely different outcomes. And the difference between them was not luck, not inside information, not a faster computer or a more expensive subscription. It was understanding a set of connections that most retail investors have never been shown clearly. This isn't about geopolitics, it isn't about taking a side in a conflict, or predicting the outcome of a war, or pretending that any of us know how this ends. It's about understanding that major geopolitical events do not create random market chaos. They create patterns, specific, recurring, analyzable patterns that have played out across decades of market history, in every major conflict, every energy crisis, every wave of international sanctions. These patterns move real money through real sectors in ways that are not secret, but are also not widely explained. Most retail investors treat geopolitical events as weather, something that happens to the market from the outside, unpredictable and uncontrollable, best endured by doing nothing. The investors who profit from these moments treat them as information, compressed, urgent, actionable information about where capital is about to move. I'm going to show you exactly how the Russia-Ukraine war has been moving U.S. stocks since it began, the specific sectors and mechanisms involved, how informed traders have been positioning around these movements, and what framework you need to stop being the person who closes the app and goes to make coffee. This is not a prediction about the war. It is an education in the market mechanics that the war has already set in motion. Mechanics that continue to operate whether the conflict escalates, de-escalates, or drags on for years. Understanding them does not require you to know how the war ends. It requires you to understand how markets respond to the conditions the war creates. Pay close attention, because the investors profiting from this are not smarter than you. They just understand the connections. The first and most important thing to understand is that the Russia-Ukraine war is not primarily a military story from the market's perspective. It is an energy story, a commodity story, and a defense story, and those 3 narratives have been moving billions of dollars through the U.S. market since the first week of the conflict. Start with energy, because it is the largest and most direct channel. Russia, before the full-scale invasion of Ukraine in February 2022, was one of the world's largest exporters of natural gas and a significant exporter of crude oil. Europe was deeply dependent on Russian energy infrastructure. When the conflict began and sanctions were imposed, that dependency became a crisis. Europe needed alternative sources. It needed them urgently. And the United States, with its rapidly expanded liquefied natural gas export capacity, was one of the most significant alternatives available. The result was a structural, sustained surge in demand for U.S. LNG exports that sent energy sector stocks on a run that lasted well into 2022 and reshaped long-term investment patterns in the sector. Companies involved in LNG production, export terminals, and pipeline infrastructure saw their valuations respond directly to every development in the European energy supply crisis. But here's what most people miss. This was not a short-term spike that corrected back to baseline. It was the beginning of a structural repositioning of European energy supply chains, a repositioning that has continued, involves multi-year contracts, and had sustained effects on U.S. energy company revenues. The war did not create a moment in the energy sector, it created a shift. And the investors who understood that distinction early captured returns that the wait-and-see investors completely missed. The second major channel is defense, and it is the one that has attracted the most sustained long-term capital movement of any sector affected by the conflict. When Russia launched its full-scale invasion, it triggered something that geopolitical analysts had been discussing for years, but that financial markets had not fully priced in: a fundamental reassessment of European defense spending. NATO members, most of whom had been well below the alliance's 2% of GDP defense spending target, suddenly faced enormous political and strategic pressure to increase their military budgets significantly and rapidly. This was not an aspiration, it became a policy commitment, backed by specific budget allocations across multiple governments simultaneously. The defense sector implication was direct and calculable. When multiple major economies announce simultaneous substantial increases in defense spending, the companies that supply the equipment, systems, and technology that defense spending buys see their forward revenue projections change materially. Their order books expand, their contracts lengthen, their earnings visibility improves. U.S. defense contractors, the companies that build the weapon systems, aircraft, missile defense infrastructure, and military equipment that NATO members were now urgently seeking to acquire or replenish, were among the most direct beneficiaries of this dynamic. It gets worse for anyone who ignored this. The defense spending increase was not a one-year budget decision. It was a multi-year strategic shift driven by a security reality that has not changed. Every month that the conflict continues, every missile system transferred to Ukraine, every piece of equipment that needs replacing or replenishing, every government that revises its defense budget upward in response to the changed threat environment, all of it flows, eventually, into the order books of the companies that make these systems. The third channel is commodities, and it is the most complex but also the most instructive in terms of understanding how geopolitical supply shocks move through markets. Russia and Ukraine together, before the conflict, accounted for a significant portion of global wheat exports, a substantial share of global corn supply, and an enormous percentage of global sunflower oil production. Ukraine is one of the most fertile agricultural territories on Earth. Russia is one of the largest grain exporters. When the conflict disrupted both of these supply chains simultaneously, the effect on global agricultural commodity prices was immediate and severe. This matters to U.S. stock investors for a reason that is less obvious than the energy or defense connections, but arguably more durable. When global food commodity prices rise sharply, the companies that benefit are not just commodity traders. They are the entire upstream agricultural supply chain: fertilizer producers, agricultural equipment manufacturers, crop input companies, grain storage, and logistics businesses. The agricultural sector is vast, and a sustained commodity price elevation driven by a geopolitical supply disruption affects it at every level. Fertilizer companies, in particular, experienced one of the most dramatic valuation moves of the entire conflict period. Why? Because Russia is also a major producer of the inputs that go into fertilizer, specifically nitrogen and potash, and sanctions on Russian exports created supply tightness in the global fertilizer market precisely when agricultural producers were under pressure to maximize yields. The companies positioned on the right side of that supply dynamic saw their stock prices reflect it in real time. I'm not done yet, because there is a fourth channel that most analysts underemphasize, and it has been quietly operating throughout the entire conflict in a way that directly affects the U.S. technology and semiconductor sector. The conflict has been an accelerant for a trend that was already underway, which is the strategic decoupling of Western supply chains from geopolitically unreliable sources. And that acceleration has significant long-term implications for specific technology companies. The war reinforced, with considerable urgency, the lesson that dependence on adversarial or unstable geopolitical partners for critical industrial inputs is a strategic vulnerability. Europe had learned this lesson about energy from Russia. The broader Western alliance was already learning it about semiconductors and rare earth materials from China. The conflict made the general argument that supply chain security is a national security issue impossible to ignore at the policy level. The result has been an acceleration of government support for domestic semiconductor manufacturing, critical mineral sourcing, and advanced manufacturing capacity, most visibly in the United States through legislation that committed hundreds of billions of dollars to reshoring these capabilities. The companies positioned to benefit from that policy shift, domestic chip manufacturers, materials suppliers, advanced position around these dynamics, because understanding the connections is only half of the framework. The other half is knowing how to act on them without making the mistakes that cost most retail investors money even when they have the right general idea. The first principle of geopolitical trading is that the market moves on anticipation, not confirmation. By the time a geopolitical development is fully reflected in mainstream financial news coverage, the sophisticated capital has already moved. The price has already adjusted to reflect the known information. The opportunity for the retail investor who reads about it that morning and acts that afternoon is considerably smaller than it was 2 weeks ago, when the signals were emerging but not yet obvious. This means the framework has to be built before the headline, not in response to it. The investor who profited from the defense sector run after February 2022 was not the one who saw the news and bought defense stocks that afternoon. That investor captured a fraction of the move that had already happened. The investor who profited most meaningfully was the one who had already understood the NATO spending gap, already identified the companies that would benefit from closing it, and was positioned before the conflict began or very early in its development when the policy logic was clear but not yet widely priced in. The practical implication is this: geopolitical situation awareness is not a reaction skill, it is a preparation skill. The framework needs to exist before you need it. The second principle is sector correlation mapping, and it is the specific technical skill that separates investors who use geopolitical information productively from those who simply feel more informed without acting more effectively. Sector correlation mapping means understanding in advance which sectors and which specific types of companies within those sectors have historically responded to specific categories of geopolitical events: energy supply disruptions, defense spending increases, agricultural commodity shocks, supply chain decoupling policy. Each of these has a relatively consistent historical pattern of sector response. It gets worse for investors who skip this step. Without a correlation map, geopolitical awareness produces anxiety without direction. You know something important is happening. You know it is affecting markets. You do not know specifically where to look or what to do. You end up making broad, unfocused bets, selling everything, buying nothing, or making random moves driven by news cycle anxiety and capturing none of the structural opportunity. With a map, the same awareness produces a checklist. Significant energy supply disruption affecting European markets? Check the LNG export companies, the domestic energy producers, the pipeline infrastructure businesses. Defense spending increase across NATO? Check the major defense contractors, the missile system manufacturers, the cybersecurity companies with government defense exposure. Agricultural commodity supply shock? Check the fertilizer producers, the agricultural equipment companies, the crop input suppliers. The map does not guarantee a profitable trade, nothing does, but it transforms a chaotic, anxiety-producing global event into a structured analytical process, and structured analytical processes applied consistently produce better outcomes than reactive emotional decisions over any meaningful time period. The third principle is time horizon clarity, and it is the one that most retail investors get wrong even when they have the sector analysis right. Geopolitical events create market movements across multiple time horizons simultaneously, and the trade that works over 2 weeks is often not the same trade that works over 2 years. Confusing them is expensive.
In the early weeks of the Russia-Ukraine conflict, energy stocks spiked sharply on the immediate supply disruption narrative. Some of that spike was a short-term repricing that partially corrected as markets adjusted. The investors who bought into the energy narrative at the peak of the initial spike and expected it to continue linearly were disappointed. But the investors who understood the difference between the short-term price spike and the long-term structural shift in European energy supply chains, who held their positions through the short-term volatility with a clear thesis about the multi-year demand reality, captured something significantly more valuable. The psychological insight here is important. Short-term geopolitical volatility produces exactly the emotional environment that causes investors to make their worst decisions. Prices move sharply. Uncertainty is high. Every new headline seems to change the picture. In this environment, the investor without a clear time horizon thesis will exit too early, enter too late, or abandon a sound position at exactly the wrong moment because the short-term noise felt like a fundamental change in the story. Clarity about time horizon is not just an analytical preference, it is a psychological protection against the emotional volatility that geopolitical events reliably generate. There is one more dynamic worth examining, and it is the currency and safe haven effect that most equity investors overlook entirely because they're focused exclusively on stock prices. Major geopolitical crises reliably produce flows into traditional safe haven assets, the US dollar, US Treasury bonds, gold. These flows are not random. They are the predictable response of global capital to uncertainty, move toward the most stable, liquid, government-backed stores of value available. For U.S. equity investors, understanding the safe haven flow matters because it affects the dollar, and a strengthening dollar affects the earnings of U.S. multinational companies in ways that are direct, calculable, and frequently underappreciated by retail investors who look only at a company's domestic business performance. When the dollar strengthens significantly, as it did in the periods of peak uncertainty in the Russia-Ukraine conflict, U.S. companies that earn a large portion of their revenue internationally see those foreign earnings translate back into fewer dollars. The business performance may be unchanged. The reported earnings in dollars decline. And if investors are not accounting for this currency effect, they will be confused by earnings reports that disappoint despite apparently strong business fundamentals. The investor who understands this connection can anticipate which companies are most exposed to dollar strength headwinds, avoid or underweight them during periods of peak safe haven flow, and reposition when those flows reverse and the dollar begins to weaken, which is a moment that historically has been favorable for international revenue earners. Return to the trading floor. Same screens, same numbers shifting, same headlines running. Remember the two investors from the beginning? Same platform, same day, same headlines. Two completely different outcomes. Here's what was actually different between them. The first investor had information, plenty of it, the same information everyone had, the headlines, the news alerts, the market commentary, the expert opinions cycling through every financial channel. She was not uninformed, she was unframeworks. She had no structure for converting what she was seeing and reading into a coherent picture of where money was moving and why. So she did what people without frameworks do in moments of geopolitical complexity. She waited. She absorbed the anxiety, she let the market happen to her, and hoped the discomfort would pass. It did pass, but the opportunity passed with it. The second investor had built something different, not a crystal ball, not privileged information, not a more expensive subscription or a faster data feed. She had a framework, a clear, logical map of how geopolitical events translate into market sector movements, built from studying how these patterns had played out historically and applied with specific pre-identified positions. When the headline appeared, she was not deciding what to do. She had already decided. The headline was confirmation of a thesis she had already developed, not the beginning of an analytical process she was attempting to run in real time against a moving market. The Russia-Ukraine war did not create random chaos in U.S. financial markets. It created patterns: energy, defense, agriculture, supply chain decoupling, safe haven flows. All of it moved with a logic that was visible to anyone who had taken the time to understand the connections before the headlines demanded it. The investors who profited were not smarter, they were not luckier, they were simply prepared to see the structure inside the noise, while everyone else was watching the noise. Geopolitical events will keep happening, markets will keep responding to them. The question is not whether these patterns will appear again, they will. The question is whether the next time a headline moves the market, you'll be the investor who closes the app to make coffee or the one who already knows exactly what to do. The map is what makes the difference. Build it before you need it. If this changed how you think about markets and geopolitics, share it with someone still reacting to headlines. Subscribe. There's more of this coming.